क्या होता है? Long-term capital gains tax, which is being called the villain of the stock market. Is this tax for everyone? Hello friends. As exciting as it sounds to make profit in the stock market, it is also difficult. Every investor puts money in the market thinking that he will get a big profit in the long term, but what if a large part of your profit is deducted as tax? An important reason behind the recent decline in the Indian stock market is considered to be the long-term capital gain tax. The debate between investors and experts is on whether the long-term capital gain tax should be abolished completely so that the Indian stock market can regain its old speed. But it is important to understand what long-term capital gain tax is and why it has become such a big issue for investors. Today, we will discuss this topic in depth. But before that, if you are new to our channel, please don't forget to subscribe to the channel so that you will be the first to get our new video updates. So let's start today's discussion without any delay. Capital gains tax is levied on the profit on sale of a property, and it is of two types: short-term capital gain, STCG, and long-term capital gain, LTCG. If an investor holds a stock for more than 12 months and then sells it, then long-term capital gain tax is applicable on him. Most of the people who invest in the stock market buy stocks for the purpose of long-term profits, but because of this tax, they have to give a part of their profits to the government. The main reason for the ongoing decline in the stock market is being said to be long-term capital gain tax. In Budget 2025, Finance Minister Nirmala Sitharaman increased the rates of this tax, which increased dissatisfaction among investors. The government increased the rate of short-term capital gains tax from 15% to 20%, while the rate of long-term capital gains tax was increased from 10% to 12.5%. This had a direct impact on those investors who invested money in the stock market for the purpose of long-term investment. Along with the increase in long-term capital gain tax, the government also gave some relief to investors. In Budget 2025, the capital gains tax exemption limit has been increased from 1 lakh rupees to 1.25 lakh rupees. This means that if an investor earns a profit of up to 1.25 lakh rupees in a year, then he will not have to pay long-term capital gain tax. However, this relief does not mean much for the big investors who earn profits of crores of rupees. However, the effect of long-term capital gain tax is not only limited to Indian investors, but it also applies to foreign institutional investors, FII. India is one of the few countries that levy long-term capital gain tax on stock market. In America, Britain, Singapore, and many other countries, such taxes are either very low or have been completely abolished so that foreign investors are encouraged to invest there. Foreign investors are getting frustrated with the presence of this tax in India, and they are withdrawing their money and investing in countries where the tax is low. Investors and market experts believe that due to long-term capital gain tax, the profits of those who invest money in the stock market are reduced significantly. This puts more pressure on those investors who want to make long-term investment by investing large capital. Such investors now have to take into account the impact of tax before investing in the stock market, due to which the speed of investment is slowing down. Stock market analysts say that if the long-term capital gain tax is completely removed, then foreign investors can return to the Indian stock market. This will increase liquidity in the market and strengthen the confidence of investors. The higher the flow of investment in the market, the faster the market will see, and this will also strengthen the economy. But the government does not fully agree with this argument. The government believes that the long-term capital gain tax is not the only reason why the stock market has fallen. The government says that the ongoing uncertainties in the global market, the increase in the interest rates of the American Federal Reserve, and problems like overvaluation in the Indian market are also becoming a challenge for the market. However, investors say that removal of long term capital gain tax will provide immediate relief to the market. The government also has to understand that if the trust of foreign investors remains on the Indian market, then it will increase revenue collection in the long term. When there is more investment in the market, companies will grow faster, so the government will get more revenue through other taxes. Apart from this, the effect of long term capital gain tax is not only limited to investors, but it also affects the liquidity and growth of the entire stock market. When investors see that a large portion of their profits will go in the form of taxes, they think twice before investing in the market. This reduces the trading volume in the market and slows down the flow of investment. If the long-term capital gain tax is completely removed, then retail investors will benefit the most. Especially those small investors who are investing through SIP or directly in the stock market, they are facing the most trouble from this tax. Apart from this, removal of long-term capital gain tax will also benefit startups and new companies in India. When investors get more profits in the long term, they will be encouraged to invest in startups and small companies as well. This will promote entrepreneurship and new businesses will be able to grow rapidly. But the question is whether the government will remove the long term capital gain tax so easily. By removing the tax, the government will lose thousands of crores of rupees every year, which it invests in other schemes. The government has to balance how to give relief to investors and at the same time not reduce the revenue. However, the opinion of investors is divided regarding long term capital gain tax. Some investors believe that this tax helps stabilize the market and contributes to the government's income. At the same time, some investors find this tax an unnecessary obstacle, which prevents the flow of investment in the stock market. Now it will be seen whether the government takes any concrete steps to eliminate long term capital gain tax or not. If this tax is removed, it can cause a huge boom in the stock market. Foreign investors will return, new investors will invest in the market, and the Indian economy will get a new
This video
strength.
has taught you something new. Do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestion. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources news from various news agencies, opinion polls, and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.